Welcome to the UTA's Truck Talk. This is podcast number 3. I am Mike Gardecki. Today's podcast interview is in regards to finance in today's market. Prior to that interview, I'd like to review some of the upcoming events and news for the UTA. Right around the corner on September 11th is the UTA's Topgolf event in Dallas, Texas. This event agenda not only includes Topgolf, but also the Peterbilt Planet Tour. Also coming up at the end of September is the UTA T-Walk event from September 29th through October 2nd. This is an all-inclusive deal, 2 nights lodging in private and gated upscale cabins, all meals included. These are actually chef-prepared meals along with guided fishing that Wednesday and Thursday. We also have the UTA Jerome Nerman Family Foundation scholarships. The application deadline is Monday, September 15th, 2025. There are 6 $6,000 scholarships for full-time students at accredited 4-year college or university. Also 6 $6,000 scholarships for students at accredited vocational technical institutions focusing on diesel mechanics and or bodywork. Here's a brief on some of the great articles coming up on the e-newsletter. Board News and Views from Cindy Bloom talking about convention plus extra things to do in San Diego. Charles Bowles of the marketing committee wrote an article, The Value of Relationships. Ian Cifuentes, sorry Ian if I butchered that, of the marketing committee as well, writes about semi-truck accident compensation, what you can expect. Also, opinion by Richard Rodriguez Long, article titled The Great Trucking Shakeout, How Mass Company Closures Are Reshaping the Heavy-Duty Truck Market. Member Spotlight showcases Chasm Kane's article, Building a Career and a Life on Relationships, Resilience, and Peterbilt Pride. And as usual, the industry news briefs, alternative fuel news, and all other events coming up that you can find at uta.org. With that, let's get on to the interview. Hey everybody, welcome to podcast number 3. I'm Mike Gardecki of TMSI.
And this is Scott Wynn with American Truck Centers.
This week's podcast is F&I. What the heck is really going on in that world today? Our guest today is Kevin Ratliff, Finance Manager with Vanguard Truck Centers out of Nashville, Tennessee. Kevin, welcome to our podcast. Can you give us a little bit of your background, please?
Hey, Mike. Hey, Scott. Thank you guys for having me on. I've been in finance, particularly truck finance, for the last 6 years. Prior to that, I was in the automotive industry. I did sales and finance management in the automotive industry. So pretty long background in finance and really loving the truck world.
We'll kick it off here, Kevin. So tell us, what's a day in the life of Kevin Ratliff? What does a typical workday look like for you?
So that's a tough question to answer. A typical workday could be a ton of different things. I would say your average day pretty much consists of, getting to work, checking on deals that have been submitted over to lenders, following up with those customers, giving them updates on approvals, declines, trying to close a deal with those customers, checking in with our salespeople, going through new deals that they have to submit, staying in touch with sales management, so on and so forth. And it's somewhat of a revolving cycle there that just kind of eats its own tail day in and day out.
Awesome. All right, let's get into some questions. We polled some random UTA members out there, and these are some of the questions we got back in. So bear with us as we work through this. So regardless of occurrence, there's a belief that the Fed will cut the rate in or near September and quarter 4. How do rate cuts affect commercial lending, and how could this potentially affect our marketplace through the finance lens?
Good question. So federal rate cuts and just the federal rates in general directly impact commercial lending. Sometimes you don't see it or feel it immediately, but it is somewhat of a trickle-down effect. All of the lenders that we use as dealers are basing their rates off of the Fed. Now, if a rate gets cut in Q4, we might start to see some trickle-down effects and seeing a little bit lower rate on commercial truck loans. I would think somewhere around first of the year. Just like with anything with a bank, it takes time to make changes, process changes, rate changes, anything like that. So it's going to take a few months. Over the last couple years, we've seen rates fluctuate quite a bit. Most of it has been increases. We really haven't seen many decreases that you can really put your finger on, but they do directly affect the commercial loans that we deal with in getting our customers financing for the trucks that they're buying. On the used side, I think that it's a little bit little bit less of an impact than you might see on the new truck side. I think it takes a little bit longer for those rate changes to hit the marketplace. And I also think that it's got less of an effect on the commercial loans that we see than it does on the new truck side, because the loan amount is typically much, much smaller, which means the rate is less impactful on the loan.
Now, I've heard that, they're talking about lowering it 1 or 2 times. Typically, that's about a quarter point would be what we could hope for. How far do you think the rate really needs to change before we start seeing an uptick in interest of buying?
I think it's got to go a pretty substantial amount, to be honest with you, Scott. I think that to really get the segment of buyers that I think we've been missing over the last year and a half, 2 years, I think it's got to drop, pretty substantially. I mean, just a quick little, anecdote. I've got a customer that bought his very first truck in 2017. He financed it with a major captive lender. He told me that his interest rate was right around 15%, and there was no way that he was ever going to pay 15% again on a truck loan. Fast forward from 2017, rates right now for owner operators and, small fleet customers are probably going to be 4 to 5 points off from where they were pre-COVID. So it's a pretty big swing. It's the same as, the mortgage conversation that everybody likes to have. Everybody that got a mortgage, pre-COVID or refinanced during COVID, they've got these 2.5, 2.75, 3% interest rates. Right now, I think the best that you can do is, maybe somewhere in the high 5s, 6s. So, it's a 3, 4, 5 point swing to really get things back to where they were before.
And honestly, or another question I kind of have on that, and this is more of a big picture, but I mean, another great thing with rate change would be the confidence it would instill or build in an investor on a larger scale to get into manufacturing, which then has that trickle down effect into getting more freight on the road, which bumps our freight rates, makes everybody happy, gets demand up for buying trucks. I mean, again, maybe outside of the scope asking this question, but do you think a full point would get us there? Or I mean, it definitely helps us step in the right direction, but I mean, how that big scale trickle down effect, what do you think that, what would be some good goals for us to be able to obtain?
Yeah, I think a point is a very obtainable goal. I think it's realistic. I think it definitely can have a pretty large effect, in the grand scheme of things. Like you said, there's several different things that interest rates can impact. It's not just the loans that we're getting for our end user, for our customer. I think that if things were to go down a point, I think that definitely changes kind of the whole landscape of what we're seeing right now in the marketplace.
Cool. We'll shift it up a little bit. So how is the volume of lending options, talking about physical bank counts out there or available lenders, how has that changed since COVID?
It's changed drastically. We've seen banks go out of business. We've seen banks completely close up their transportation divisions. We've seen them get out of over-the-road business and constrict themselves to vocational or medium duty. Prior to COVID, I probably had 50 to 60 different lenders that we would use on a regular basis. I'm not saying that we're doing, 100 deals a year with each lender, but to be able to have that kind of a, Rolodex of lending institutions and banks that you can go to really makes the job that much easier and makes it that much simpler to give your customer a ton of different options. Over, the last, I'd say 3-4 years, that list has probably been cut in half, maybe even down to a quarter of the size. Now, that's not to say that, half of the lending institutions that we use just closed up shop and went out of business. Like I said, a lot of them just changed their requirements. And in the used truck space, it can really hurt us because, where we had banks that would do great interest rates, really good, good loan types, simple interest loans, things like that. A lot of those lenders have changed their requirements to really target the new truck fleets, where they want you to have 10 years in business, 20, 30 trucks in fleet. So essentially on the used truck side, other than a few deals here and there, it basically just cuts them out of the used business because, as you guys know, the majority of the end users that we deal with are either owner operators, small fleets. We do see medium and large size fleets buying used trucks now, but that's really more of, just the drive and demand that the new truck business has put on used trucks. And we'll get into that a little bit, here in a little bit.
Okay.
What does a high-risk loan look like in today's market versus pre-COVID market from, say, the banking's point of view or lens?
Sure. So prior to COVID, and I hate to just keep saying COVID, but really that's, what changed everything in our world. Prior to COVID, a high-risk loan on a used truck, maybe was a customer, an owner operator that's going from his first truck and now he's wanting to buy his second truck. That's always been a big risk for lenders out there. Maybe he didn't have excellent credit. Maybe his credit was okay. He's for the most part paid his bills, but he's had a few hiccups. That was kind of an average deal back then. The big difference that I've seen is now that customer is what you would consider a high risk. Whereas, pre-COVID, to really talk about a deal that was difficult to get done or high risk or something like that, you're talking about a guy with terrible credit, a credit criminal, hasn't paid anybody. That's a tough one. Nowadays, it's really, really difficult to get owner operators financed in general, whether they have good credit or mediocre credit, bad credit. Lenders are not excited about lending money to, a single truck operation or a 3-truck operation or a 5-truck operation. They want sustainability. They want to know that, this one truck isn't the make or break for them. That if this truck breaks down, that they've got, 30 more that are paying the bills. And so I think that's the big shift that we've seen is that it's no longer so much about, hey, just what's your credit look like? It's really, what kind of business are you? If you're just the one truck mom and pop kind of guy, it's gotten a lot harder to get financing.
Well, and this plays in beautifully. I mean, so at American Truck Centers, our customer base is a wide range of buyers, from small owner operators to large fleets. So how would you tailor financing solutions to meet the needs of these different segments, particularly those with less than perfect credit?
Sure. The biggest thing I can say about, tailoring your financing options is having a variety of lenders and programs with those lenders. I can't preach that enough. There's so many dealers that I've talked to and met and, had conversations with, and they really only have, 3 or 4 lenders. Maybe they have a captive if they have a new truck franchise. Maybe they've got a couple other major players in the commercial lending space. But there's so many different banks out there, and you've got to know who does what, who specializes in what, and you've got to know where to send your deal. So, just having that big portfolio of options and places to send deals to is the most important thing. And on top of that, like I said, knowing what those lenders buy and what they like and what they don't like helps big time to speed up the process and to know that when you submit a deal, you're going to get an approval back.
Yep. That rolls right into the next question. What are the key financial metrics you would focus on when evaluating a customer's creditworthiness for a used truck loan beyond traditional credit score? What red flags would concern you?
That's a tough question. I think, credit score is still important. It always will be important. Honestly, it's probably more important now than it was before, because there's so much risk and volatility in our market, right now and over the last few years, that lenders have really leaned on that credit score. Now, that being said, in the used truck space, I think what should really be considered and what more lenders, I think, are trying to adopt is really looking at the customer's business and their business model. So, do you have a guy that wants to buy and finance a truck and he's not really sure who he's going to haul for? He's got his own MC number. Maybe he'll pick up loads on the load board. Or do you have a guy that's got, a designated route that he already has a contract on with FedEx or with JB Hunt, or somebody like that. I think having some, again, sustainability and having that contract to fall back on and a clear and set business model and business plan is huge for any lender or bank that's going to loan money to somebody that's a single truck operation or a small fleet. Because look, if you're giving out money and you're loaning it to a company that has 50, 100 trucks, they've got a business model, they've got lanes that they're already dedicated to. You don't really have to worry about their ability to make that monthly payment. But with the smaller fleet, with the owner operator, I think that you've really got to dig into their plan, their business model, who they do business with, where they're getting their hauls, how much they're spending on their fixed costs, their insurance, their taxes, their plates. All that stuff really goes into painting the picture of how profitable and how sustainable that business plan can be. And those are the big important things, when you're looking past a traditional credit score. As far as red flags, kind of tied into what I just said, somebody that doesn't really have a plan, that's definitely a red flag. Somebody that has never done this before, that's always been a tough one to overcome. Somebody that hasn't been in trucking, somebody that hasn't financed a truck, somebody that doesn't know, how to go out and book a load and find a load. Those are all big red flags, because as soon as you sign that loan contract, there's a payment that's coming due, and you've got to be able to have insurance and plates and get that truck on the road and get it making money.
Well, it's like when I was retailing, I always related that to my customers. Look, you're not buying a truck, you're buying a business, and you need to have a business plan going into this. Well, we'll roll into, so assuming a 72-month COVID term expires in 27-28, presumptuously assuming bad paper, what are foreseeable changes that could spark in commercial lending once bad loans are off the book? So we've gotten through a lot of that kind of high-end sludge that we've accumulated.
Yeah, I think we're kind of starting to see a little bit of that right now. Delinquency rates and repossession rates have been at all-time highs on over-the-road trucks, especially over the last 12 to 18 months, maybe even up to 24 months. So we're on, I feel like, the downward side of that mountain. Once more of those loans get off the books and banks have resold those trucks or taking them to auction, whatever they do, I think that we'll start to see a little bit of leniency on the lending requirements, and things might loosen up a little bit. But like I said, right now they're in the thick of it. They're taking the losses, and it's large. So the closer we get to those loans maturing and being paid off, the better off we will be, for sure.
Now, I have heard outside of traditional market, they're handling it with, they know what they're working with, that some of these guys, they're approaching them, they're saying, we don't have, hey, we can't make this, or, I've heard that banks are working with people, because ideally it's a lot easier to keep a guy in a truck that is in contact with you versus repoing a truck and taking a big loss right up front.
Definitely. Yeah. Lenders, especially, the ones that I work with on a day-to-day basis, they have been very good over these last couple of years about working with customers and trying to get resolutions made on their loans, and if that means they need to do a loan modification or putting a payment on the back end of the loan, that stuff we have seen quite a bit. And you're exactly right, it's much simpler to work with the customer that you already have on the asset that's already on the road and try to make it right and find a solution with your customer to keep business flowing, rather than going through a repossession process. You've got all sorts of costs that pile up with repossessing a truck or multiple trucks. It could be a multiple truck loan. That's definitely a last case scenario.
How's the current lending requirements affecting leasing? And with that, how do traditional loans look different from a leasing loan?
So I think that we've seen more of a demand in the leasing sector because of the difficulties of getting a traditional truck loan. Now, typically a lease is going to come with higher payments. I've seen it be as much as 5 and 6 times the payment amount of a normal traditional truck loan, but it's also usually a lot easier to get approved on a leased truck. Your credit doesn't have to be perfect. It doesn't have to be great. You don't have to have financed a truck before. All that stuff, is a little bit more lenient. And so it's really given more of a demand on the leasing side. Now, in the used truck space, I don't know that we see as much of that as, you might see on the new truck side, just because of what the payment amounts are. They're much higher. And typically, if you're leasing a truck, you're leasing, a new truck, or you're leasing one that's, 1-2 years old, not necessarily, the standard 4 to 5 year old truck with, 300,000 to 500,000 miles on it.
So with that question, what percentage difference you mentioned that you see leasing has increased? What percentage difference ballpark do you think you see is going into leasing as opposed to traditional financing in today's market?
I would think that we're probably seeing 20% more on the leasing side. It's nothing huge and major in the grand scheme of things, but depending on the size of the business and the size of the sales operation that you have, 20% can be a pretty large chunk. Now, the good thing about that is many of the lending institutions that we all use in this space offer leases. And I think we've also seen more lenders that in the past maybe didn't offer leases have kind of started to move into that space, where now they're offering, FMV leases, track leases, things to give customers more opportunities to buy and more opportunities to, own a truck, versus a lot of places before COVID, they did their one type of loan and that was it. So I do think that we've seen several different lenders kind of open up what they can bring to market.
Shift it up. So what book value is LTV based on? And how can we, as sales professionals, find said value?
That is a phenomenal question, Scott. And if you find out the true answer, please let me know. It really just comes down to what bank or what lender that you're working with. I've seen lenders use JD Power. I've seen them use Black Book. I've seen them use NADA. I've seen them not really use a book value at all, and they get on truck paper and they pull comps and they go based off of that. So it really varies greatly across the board. Obviously, the bigger the lender is, the more streamlined of a process that you're going to see out of them. The BMOs, the Mitsubishis, the captive lenders, they're going to use one particular way to value a truck, whereas the smaller ones, might be a little bit more willing to work with you. Maybe they'll look at truck paper, maybe if you send them comps, they can help with that kind of stuff. I've got several banks that I use on a regular basis, and, sometimes they'll come back and say, hey, this value is really far off. We're pulling this truck at 47,000 and you guys are selling it for 69.9, and I'll jump on truck paper and I'll pull up, all the similar year, make, model, similar miles. And, I'll compile as many as I can and I'll send them over to the lender. And they're just looking for a reason to say yes and a reason to see your side of the picture, I guess, see your side of the coin. And that's our job as finance managers, is to be able to paint that picture and show them why we're pricing the truck the way we are, and, show them that we're not crazy, show them that we're in line with everybody else.
Well, I know this kind of fits in here, and I don't want it to be redundant, but would you say there's any hard cutoffs that are a good rule of thumb for everybody listening? I know traditionally it's 550 and 4 years old, but or 5 and 5. Is there anything you're seeing? Because I know as I'm presenting trucks and talking to folks, I'm hearing some guys that are saying 19's the kiss of death, they can't get it financed, and I got other guys saying that they can go down to a 17 for finance. So, what's a good generalization here?
Yeah, there's really no good rule of thumb. I guess, if you want to play, with the majorities, yeah, I would think, 2018, 2019, 500,000 miles or less is probably a good rule of thumb. Now, can we get a 2016 financed? Yes. I've got several lenders that'll do older trucks. I've got several lenders that don't have mileage caps. We've also got lenders on the flip side that, will only do a 2023 with less than 300,000 miles. So again, not to be redundant, but it really falls back on what lenders you have in your portfolio and your Rolodex, and knowing what programs all of those lenders offer, because as long as you have a place, for every deal to go, nothing's impossible. I've seen 10-year-old trucks get approved with 1 million miles on it. There's definitely, a place for every truck.
So we're talking about loan to value, LTV. Is there a certain number or percentage like for A, B, and C paper, or is every lender different?
Every lender is going to be a little bit different. And then, like you said, it's going to depend on what that customer's credit rating is with that lender. If you've got an A credit lender with, what I would consider to be a prime bank that does, good credit customers, lower on the interest rates, that kind of thing, they're going to loan more. They're going to give more loan to value than, a middle of the road type bank that's lending to, your mediocre credit guys, or even maybe your bad credit guys.
Kevin, how do lending practices differ from regional haul, long haul, and last mile equipment?
Good question. So they change a lot. Just in the terms of kind of risk classifications, over the road is as risky as it gets in what we do in our business. And then from there, it gets less risky and less risky. So, if you move down to, a regional haul, like maybe it's a mid-roof truck that's doing just, regional loads, or maybe it's a day cab, you get a little bit more leniency from the lender on credit requirements, interest rates. Term on the loan is always a big one. And then from there, if you go down to kind of that final mile delivery stuff, box trucks, straight trucks, it gets even less. So, what we've seen again over these last several years is the big focus get put on over the road and how great the risk is with those types of assets and the loans that go with those assets. So, the more medium duty, local haul, regional haul stuff that you can get your hands on, I'm not saying that it's the hottest seller out there right now by any means, but it is typically easier to get those trucks financed.
How competitive are local banks in comparison to commercial lending? There used to be a pretty decent gap years ago when I was in the retail side. I just wonder where that's at now.
I think there's still definitely a gap as far as how competitive they are. If you have a customer that does go to their local bank, their credit union, something like that, 9 times out of 10, if they get approved at that local bank, the deal is going to be much better than what our, quote unquote, traditional commercial lenders can do. Now, on the flip side of that, like I saw, a decent amount of that before COVID. And I think it's one of those deals where you don't know until you know. And a lot of those banks don't really understand the risk maybe in loaning money on an over-the-road truck or even a day cab or anything like that. So I think we've seen less local banking institutions offer loans in general on heavy-duty truck.
In the past, I'd really never hear of credit unions getting into the commercial side. Is that something they're doing since COVID, or were they doing that prior to COVID?
No, I think it's really all about the customer. I've never had a credit union or a local bank reach out and say, hey, we want to finance your truck deals. 9 times out of 10, it's a customer that already has an existing relationship with his credit union. Maybe that's, who he's got his mortgage with, or he's got a credit card with him, a car loan, whatever. And, he goes in there and says, hey, I want to buy a truck. And, they process it just like they would a normal auto loan. That's really the only time that comes into play that I've seen. I have not seen any of them really move into the, dealer indirect lending space.
Kevin, have you seen any new lenders come into the financing segment?
Not as many as we used to. We used to get phone calls, it seemed like every day, from a new lender that was popping up, or maybe a bank that, you had already heard of, but they didn't have a transportation finance division or equipment finance division. And, they wanted to get into that segment. I think for the most part, people have really seen what's happened over the last couple of years on the banking side and how volatile it is, and, the rising delinquency rates, repossessions. And so I don't think that we're really seeing as many new players as we used to.
What's the conversation regarding repos and non-satisfactory loan payments with lenders currently?
Well, the conversation that we're having, is that, again, repos and delinquency rates are, at an all-time high over these last, few years. And again, that's from a lot of those quote unquote bad loans that were done during COVID, whether that be because the customer's credit wasn't as good as maybe it should have been, or maybe that's because, they bought a truck that, sold for $100,000, and pre-COVID and post-COVID, maybe it's only worth $50,000. So it's still a tough conversation. Like I said, I do think that we're on the downhill side of the mountain, and we're moving into better territory. But for the most part, requirements are still really strict. Lending is stringent. It's still pretty tough, to get used trucks financed in general. So I don't think the conversation's really changed yet.
Now, just looking at typical term length, a lot of these loans that were put out in 21 are coming to an end, and they're either sufficed or they have repoed. So would you say that we're almost through the thick of it?
Yeah, I think we're almost through the thick of it. I think a big piece of it, though, is, trying to understand how long it'll take these lenders to come to terms with the losses. Because, let's just say your standard, used truck loan, guy puts 20% down. He's got a, 15% interest rate. By the time he gets to the end of his loan, we should be pretty close as far as what he owes versus what it's worth. 95% of the loans that were done during COVID can't ever get there because the demand was so crazy. The pricing was, so out of whack that they're never going to be in an equity position. So really it's, you hope like crazy that the loan gets paid off in full, or it's going to be a loss for the lender.
I know there's been some big mergers with some of the large banks out there. How does the continuation of bank mergers impact commercial lending?
I think as a whole, it makes it harder. The more of the smaller, mom and pop type lenders that get bought out or merge with other lenders, the harder their requirements seem to come, because at some point you've got to have some sort of streamlined, lending scorecard or credit profile that you're looking for. And, you may have had one lender that did, B and C paper, B and C credit, and maybe an A/B type lender bought them out. It's really got to kind of go one way or the other. I don't typically see many lenders that do it all, that do the A through D paper. There's several out there that say they do, but what you will typically find is that the terms and the rates and the approvals that you see on the A credit stuff is not really going to be competitive, because maybe they're really used to doing C and D paper. Maybe they're really used to doing that, BC credit, and A is just not really something they've really delved into. So the more that we see banks get gobbled up, I think the harder it gets, because, from a volume standpoint, you want to get as good a credit and as good a paper as you can get. And so having some sort of streamlined set of requirements and scorecard and, lending guidelines is really the only way to do that.
Are OEM banks like Daimler and VFS getting more competitive with used loans? Like, are they making an effort to get into that heavier?
So I will say the OEMs have done a phenomenal job during COVID, throughout COVID, post-COVID, in supporting their dealers, whether that be in used trucks, new trucks, whatever it is. They have always been there to support us and to pick up deals when it's really, really difficult to get deals done. That being said, they're not always the most competitive, because, as if you're going to kind of stick through the rough times, just like you are the good times, it's really hard to stick your neck out there when everything's kind of pointing in the wrong direction. So I would say that they're not as competitive on the rates and terms, but they're a huge asset in just being able to move equipment.
So a bit of a question for our sales guys, maybe have a takeaway here. So what advice would you give to owner ops and small fleets looking to make used truck purchases in the current market we're in?
Good question. So the biggest piece of advice is to have your ducks in a row. And what I mean by that is, before you go looking for a truck or submitting a credit application, have your stuff in order. You're most likely going to need bank statements, maybe tax returns. You're going to want to know what your income is, over the last several years. Again, I think with the way that the market is right now, the biggest thing that a buyer can do to differentiate themselves and to give themselves the best shot at getting approved on a good loan is to have all the answers to the questions, have a business plan. Let the dealer know, let the salesman know, when they're filling out the credit application, hey, here's what I'm going to do with the truck. Here's the lane that I'm going to run it under. This is kind of the revenue that I'm used to making. This is what I need to make. This is the payment amount that I really need to make this all work. The more information that a buyer can come to the table with, the easier it is to get them approved and get them into a loan that works for them and that will be profitable for them. We see so much in lending, and not just in trucks and in cars and mortgages and whatever it may be. People kind of want to play their cards, close to the vest, and they want to hold on to information. And, we don't want to get information from buyers or prospective customers to be able to, make more money on them or anything like that. Those are all the things that go into getting them the best deal that we can possibly get them and getting it in as quick of a turnaround as possible. And speed is everything, right? I mean, if it takes a month to get a guy approved, the guy's not even there anymore. So the more info you can have right up front, the easier the whole process is.
It really comes down to, to help your customers, you got to build that trust to get the information to essentially sell the sizzle to the bank as to why this guy's not going to be a giant risk for you.
Exactly.
I'm just disappointed that a signature and a social security number doesn't work for you. What are most significant trends you're seeing in the used commercial truck finance market right now? And with that, what's the current outlook for the rest of the year and into the next?
I think as far as trends go, I don't know that there's anything really new on the horizon. I think if anything, it's a little bit stagnant, as far as what we talked about, as far as, requirements that lenders have for approving a loan, the trucks that we're seeing, the pricing, I think things have somewhat leveled off a little bit compared to, what we were experiencing a year and a half, 2 years ago. So I think for the most part, it's going in the right direction, and lenders are getting a little bit more comfortable loaning money on trucks. I said a little bit, and I say it as slowly as I possibly can because it is an extremely slow process. We were having a lot of these conversations September, October of last year leading up to the election. And here we are, September, a year later, and we're still kind of talking about what the trends are and what we could see, over Q4 and into Q1 of next year. It's a really, really slow process and slow transition. So I think for right now, things are a little bit stagnant.
So here's a big one. For me, we've seen a lot of volatility lately in used pricing. How does that affect our financing offers? And what's your approach to managing risk in a depreciating asset market?
Pricing volatility is definitely a big deal, right? That's what got so many of these lenders in trouble during COVID. Now, obviously, that was an extreme volatility, probably unlike one we've seen at any other time in this market, but it definitely plays a large role, and it can help us and it can hurt us. If we see a sudden drop in pricing, sometimes it takes lenders months to really grasp that and to catch up with it. So if we see a quick drop in pricing and we submit a finance application to a bank, we may get more than favorable terms because they may look at the deal and think we're selling the unit extremely cheap. Whereas we know that's just what the market's dictating right now. On the flip side of that, when pricing goes up drastically, it makes it very, very difficult to work with those banks and get those loans done because, again, it takes them months to really catch up with that data. That data, comes from so many different places, and it takes, a certain amount of time for there to be enough of it there for a lender to really put any stock in it. So on that side, it can hurt because we submit a deal and the lender says, whoa, you're selling this truck for way too much, when you and I both know that, truck prices can swing $5,000 to $10,000 in a week or two.
Mm-hmm.
How are rising interest rates impacting our customers and in turn our business? And with that, what strategies would you propose to mitigate the impact?
They're definitely impacting our customers and our business pretty greatly. From the customer point of view, again, everything's from what can I generate what kind of profit can I generate? What revenue can I generate? And interest rate directly impacts that, right? I mean, if a guy signs a loan at a 10% interest rate, versus a 20% interest rate, his monthly payment is going to be significantly lower, which is going to in turn affect his profitability with that truck. Things that we can do to mitigate, or we can help to do to mitigate that risk or that effect is, I think more and more we've seen in the finance space, or at least I've seen, that it's not just about getting a guy a truck loan. We really need to be more of a complete dealer and more of a complete business partner. We need to be able to offer better alternatives for insurance. We need to be able to offer service contracts, warranties, whether that be through, an OEM or a third party. The more solutions that we can offer to our customers, the less impact that one number on their truck loan really has. If they're spending, $3,500 a month on their truck payment, their insurance, their, all the other costs that go along with it, if we can save them a little bit of money on each one of those things, it makes it a heck of a lot easier for that customer to say yes to the truck deal.
And I think this is the $1 million question, but in a market with increasing competition, how do you differentiate your financing services from a dealer's perspective? I mean, what value add services can you offer to the customers?
Yeah, it's a good question. And that kind of falls back into what I was just talking about. You definitely want to be a complete dealer, right? You want to be a one-stop shop as much as you can. Now, I'm not saying, for every dealer to go out there and open up an insurance brokerage and start their own warranty company and that kind of stuff. But you need to have a good grasp on what's available in the marketplace. Have some relationships with different insurance brokers or insurance companies. Have relationships with warranty companies that are going to help protect your customer, when their truck breaks down. Any of that stuff that you can offer is just going to give you a more complete portfolio and a complete solution to your customers' needs. Because again, when they're buying a truck, they're not just buying a truck. Like you talked about early, Scott, they're buying a business. It's they're starting a company. They're expanding and growing their company. And the more services and value adds that you can offer, the better. And that's I think what differentiates the great finance departments out there from the good finance departments out there to the very, very basic finance department.
Well, Kevin, I can't thank you enough for coming on with us today and shedding light on the finance side of our industry. Do you have anything that you want to ask us, or?
No, guys, thank you so much for having me. I really appreciate you having me on the call, and hopefully we brought some good tidbits to the listeners out there. And just thank you so much.
All right. Well, hey, I want to say thank you to everybody listening, and we'll see you on our next edition of the Used Truck Podcast.
Thank you, everybody.
Thank you.